Mr. Mahtani, thank you so much for talking to ET now. Let me begin with the big event, Brexit. Is it, more of a symbolic date, January 31st, and because, Britain will enter into 11-month transition period. This is not going to be the end of uncertainty. So what do you expect in the coming months, in the coming quarters, as far as the UK is concerned and the impact that this will have globally?
Well, I think most of or a lot of the uncertainty around Brexit now has kind of played out in the sense that obviously we've got the withdrawal agreement now agreed. And obviously, as you said, we've got this 11-month transition period where we're going to see quite a bit of work being done by both the UK and Europe in terms of agreeing the new trade, what the new parameters around trading are. I think it's in the interests of both Europe and the UK to get to an agreement. Obviously, there's going to be issues that both parties will have to want to resolve. But I think, one of the major uncertainties that we had really in markets last year now has been sort of reduced quite. It's
finally done.
Yes, we've had, clearly there was a political impasse in the UK. But we've now gone through one of the major hurdles. So I think in terms of the effect or the impact on equity markets, it's possibly going to be less now going forward because I think there is obviously...
We saw the pound rallying like a day before Brexit. So
yeah, I think there's now obviously, there will be I'm sure a grown-up discussion between the European countries and the UK in terms of coming to some agreements on some of these big picture issues. But I'd expect Brexit to have less of an influence on global equity markets this year than last year, for sure.
Right. How optimistic are you of them concluding a trade deal by the end of 2020? Or, are we again going to see some extensions there, like what happened with the Brexit deadline itself?
Well, it's difficult to really predict these things. So I think, obviously there could be... It's a tough order to achieve that objective. It could be achieved, but there could clearly be, an extension to that period because these are quite, lengthy, detailed negotiations which they're going to have to go through. So by all means, there could be an extension to the original deadline that they've given.
Right. Any impact at all that you see on emerging markets like India? Because obviously you have big Indian companies like, JLR, Tata Motors operating here. And they're going to have to follow a whole different set of rules. Some will be different in Northern Ireland, some will be different in the rest of UK. But otherwise, even from an equities perspective, do you see any impact on markets like India?
Not from this particular issue. No, I think there's other issues going on in India and globally, which are probably going to have more of a direct impact on the Indian equity market. So I would think that this wouldn't have so much of an impact. I think
when you say other issues, global events, can you elaborate on that?
Yeah, well, I think there's a couple of big picture issues that are going on. Obviously, India is facing an economic slowdown. There's obviously been a slowdown in consumption and economic growth over the past couple of quarters. There's obviously various reasons behind that. People are attributing it to, the demonetization, the tax, the GST. Obviously, we've had the whole MBSC crisis as well. Yes, correct. And that's, we certainly feel that this is a sort of second derivative impact of that because clearly there has been a tightening of lending to, by these MBFCs because they've had difficulty raising funds, so they've obviously slowed down their lending to the consumers. So there's various kind of reasons as to why the economy is slowing down, but the fact is that we are seeing the weakest GDP growth in India for several years. And the government is going to have to take some policy measures to try and help, the Indian economy, get through this difficult period. So it does look like it's going to be quite a difficult, period, certainly for the next few quarters for the Indian economy, which makes it quite a challenging background for Indian corporates.
Right. perception-wise, how are fund managers in London perceiving India right now? Because a lot of people feel that the government has perhaps, focused on other issues and not necessarily on reforms and the second wave of reforms that was needed. Has that impacted sentiment about India from an investment perspective?
Well, I think on a longer term view, it is something that we're very conscious of as well. It's something that we would agree that the government has not used the mandate it was given, and clearly it now has a very strong mandate to carry out reforms. I think there has been definitely several big picture areas where we would like to see more reforms, particularly in terms of the red tape, attracting more FDI,
Right.
bureaucracy, the strength of the bureaucracy,
And policy uncertainty. Policy certainty.
yeah, infrastructure, investments, getting infrastructure projects through. There's several areas that we would like to see more concrete action, which the government, has had the opportunity to, but has slightly shied away from making, some of the bigger picture decisions, and all of these factors have been, as I said, partly reasons why the growth in India now is slowing.
Right. What then explains the rally that we've seen in the stock market? I mean, there's almost a disconnect between what's been happening on the Sensex and Nifty and, the fundamentals. So who's missing the signal here? Is it, investors? Is it economists? What really explains the rally that we've seen?
Yeah, well, as you've highlighted there, and I think you've put it very well, there is a disconnect between what's happening in the real economy and what's happening in the equity market. But I think it's important to then kind of have a look, take a step back and have a look at what's happening globally in financial markets. And I think this is really the reason why we have seen the Indian equity market, perform well. We obviously are seeing monetary policy being eased in the US. We're seeing monetary policy being eased across all of the emerging markets, so Brazil, China, India, Russia. So there is a very strong flow of liquidity, which is driving financial assets, and clearly, just look at the S&P for last year. You had a 25% move in the index itself. Some individual blue chip companies were up 40-50%
Right.
in the US last year. So there's been a lot of wealth creation, and with this change in stance by the US Federal Reserve Bank last year in terms of easing policy, it's been the liquidity really that has been driving equity markets, and particularly global equity markets. But some of that money has spilled in, come into global emerging markets, and we've seen that in the data in terms of fund flows coming into emerging markets for the past few
Right.
months. They've definitely picked up. And that's been the principal mover of emerging markets over the past few months. Has been obviously, the emerging markets have benefited from that, and obviously the sort of positive initial signs from the US-China trade talks has been, one of the reasons why the sentiment has improved for emerging markets over the past few months.
Right. Finally, how worried are you about the coronavirus outbreak that we've seen? I mean, the WHO has now finally declared it a global public emergency. We spoke to Jim O'Neill recently, who seemed very concerned about the impact that this could have. How worried are you? Because, we are already seeing manufacturers pull back from China and services industries taking a hit. People are talking about entire cities becoming ghost towns. How do you assess the impact going forward? Because China is already under pressure, and now they have to deal with the coronavirus outbreak.
Yeah, so we're watching and monitoring the developments very closely. Clearly, there's going to be a near-term impact on consumption,
Right.
and we're seeing that obviously in some of those areas that are impacted. I think looking out over the next few years, though, I think China still has an opportunity to rebalance its economy away from the export sector back to the domestic economy and domestic consumption. So services and domestic consumption have risen as a percentage of GDP to over 60% of GDP over the past few years, and that trend I think will continue. So we do believe that on a medium to long term view, there are pockets of growth. There are areas of growth in China which are benefiting from the transition I mentioned. But clearly, in the near term, this is a challenging period for China and for equity markets. But we could actually find that there's some interesting opportunities that come up over the next few months in China because of this.
Right. On that note, thank you very much for talking to ET Now. Thank you.
That's great.
Thank you.